Imagine waking up, reaching for your phone, and seeing this. Your bank is collapsing. Not hacked, not robbed, just gone. That's exactly what happened to a $200 billion bank in less than 48 hours. On March 9th, 2023, customers tried to withdraw $42 billion from a single bank in one day. That's not a typo. Billions gone in hours. By the next morning, the bank was dead. Here's the thing most people don't realize. Banks don't actually keep your money. You deposit $1,000. The bank keeps a small part and lends the rest out. Think of it like this. You give a friend $1,000 for safekeeping, and they secretly lend $900 to someone else. As long as you don't ask for it back, everything works. But if everyone asks at the same time, game over. But first, let's understand how big this bank really was. Silicon Valley Bank was the 16th largest bank in the United States, $212 billion in assets. Nearly half of all U.S. tech and life science startups banked here. If you raised venture capital, your money was probably here. This wasn't just a bank. It was the Bank of Silicon Valley. And here's the dangerous part. All their customers were the same. Same industry, same investors, same behavior. That's called concentration risk. A ticking time bomb. So what did they do with all that money? They invested it, mostly in government bonds. Sounds safe. But here's the problem. They locked in those bonds at around 1% interest. Now imagine, you lend money for 10 years, at 1%. But suddenly, new deals offer 5%. Your old deal? It's now worth way less. There's a concept called duration risk. The longer your money is locked away, the more sensitive it becomes to interest rate changes. A 10-year bond is exponentially more sensitive than a short-term one. And SVB made a massive bet on long-term bonds, right at the peak of low interest rates. It was like buying a house at the top of a bubble, and then watching the market turn. Interest rates rose faster than at any point in 40 years. And suddenly, SVB had lost $15 billion, on paper, quietly, until it wasn't quiet anymore. Then came the trigger. Startups stopped getting funding, so they started pulling their money out. Now, SVB had a problem. To give customers their cash, they had to sell investments at a loss. And that's when everything broke. SVB announced they had lost billions. Investors panicked. Founders panicked. The internet exploded. Everyone wanted their money out at the same time. This is called a bank run. It's like a stadium where someone yells, "Fire!" Even if there's no fire, everyone runs. And there's only one exit. In just hours, $42 billion. No bank can survive that. Now watch how fast this happened. Wednesday, March 8th, 4 p.m. SVB announces it needs $2.25 billion. The clock starts ticking. Within hours, Peter Thiel's fund tells companies, "Get your money out." By midnight, the message spreads everywhere. Thursday, 9 a.m. Withdrawals begin. 3 p.m. Stock down 60%. Friday morning, regulators step in. 40 years, gone. In 44 hours, SVB didn't collapse because it was reckless. It collapsed because of one simple truth. Banks run on trust. The moment people lose confidence, the system breaks. And today, panic spreads faster than ever. Here's the unsettling part. SVB followed the rules. It passed stress tests. Nothing illegal happened. The system just wasn't built for this kind of speed. In the past, bank runs took days. People had to show up. Today, it takes one tweet. Regulations changed after SVB, but the core weakness remains. Confidence can collapse faster than any system can react. And the next crisis might look completely different. To stop things from spreading, the government stepped in. They guaranteed all deposits, even above the usual limits. Because if they didn't, more banks could have fallen, one after another. Here's what most people never realize. Banks don't fail slowly. They fail all at once. And all it takes is for people to stop believing their money is safe. Because in banking, confidence is everything. And once it's gone, so is the bank.